So, what's the real connection between the stock market, all those numbers flashing on our screens, and the real economy? I'm talking about the factories being built, the jobs actually being created. It's a huge question, and today we are going to dive right in and see if we can find some answers.
You hear it all the time, right? Hey, the market's up. The economy must be doing great. But is that really true? Does a soaring stock market literally cause new factories to get built? Or is something else going on? It's the ultimate chicken and egg question, and we are going to try and crack it.
And to crack this case, we're going to do something a little different. We're going to treat this like a detective story. Our main piece of evidence? A deep dive study of Nigeria's economy over a 31-year span, from 1980 all the way to 2011. This research paper is our case file, and we're going to follow the clues wherever they lead. All right, so every good detective story needs its main characters, right? The prime suspects. In our economic mystery, we've got two key players at the very center of it all. So let's get them in the interrogation room and find out what they're all about. Okay, on one side, we have the capital market. You can think of this as the world of stocks, bonds, and money that moves at the speed of light. And on the other side, we've got something with a bit of a mouthful of a name: gross fixed capital formation. All that really means is the real-world stuff, the actual roads, factories, and machinery getting built. So it's finance versus physical stuff. Let's look a little closer at player number one, the capital market. So the study defines it as the whole system where governments and companies go to raise money for the long haul. How do they do it? Well, they sell tiny pieces of ownership, we call those stocks, or they sell IOUs, which we call bonds, to anyone who wants to invest. It's really the engine room of modern finance.
And now for its counterpart, gross fixed capital formation, or just GFCF for short. This is the stuff you can actually see and touch. It's the hard evidence of a growing economy. The research defines it as all the new physical assets. We're talking everything from machinery and new buildings to the construction of roads, schools, and hospitals. Put it this way, this is the concrete and steel part of the economy.
Okay, so we've met our key players. Now the real investigation kicks off. The first thing our researchers had to figure out was, are these two even connected at all? Do they have a relationship? And this, my friends, is where they found their first major clue. So the first question is pretty simple. Do these two things have anything to do with each other? Over those 31 years in Nigeria, did the financial markets and all that real-world building move together, or were they basically strangers passing in the night? And the answer from our case file is a big, resounding yes. The study found, and I'm quoting directly here, a positive and significant long-run relationship between the two. That was the first major breakthrough in the case. So what does that actually mean in plain English? It just means that over the long haul, when one goes up, the other tends to go up too. They are connected. You could say they're dancing together. But, and this is a huge but, this doesn't tell us who's leading the dance. Does the stock market pull the real economy along for the ride? Or is it the other way around? This is the central mystery we have to solve. And that brings us to the most exciting part of our whole investigation. This is the moment of truth, the big reveal. Now that we know there's a connection, we gotta find out who the real driver is. And I gotta tell you, the answer might just surprise you. Okay, let's just lay it out there. Does a booming stock market cause all that real-world investment to happen? Or does all that real-world building and investment cause the stock market to boom? Who is the cause and who is the effect? To figure this out, the researchers busted out a really powerful statistical tool called a Granger causality test. Just think of it as a way to see which event consistently happens first and then predicts the other one. They tested two big theories. Possibility A, the stock market drives the real economy. That's what most people think. Or possibility B, the real economy is what drives the stock market. And the result was, honestly, it was pretty stunning. The evidence pointed in only one direction. The study found what they call a unidirectional causality. The influence flows from gross fixed capital formation to the capital market. Let me say that again because it's important. In this case, real-world economic growth caused the stock market to grow, not the other way around. And right here, this is the proof. The test was looking for really strong evidence of that causal link. When they tested the idea that the stock market causes the real economy, the evidence just wasn't there. But when they tested the idea that the real economy causes the stock market, well, the evidence was significant and clear. The data was pretty overwhelming, and it only supported one conclusion. So you have to ask why. Why this surprising result? Every good detective needs a motive, right? Well, the researchers gave us one. They suggested this one-way street exists because during that time period, Nigeria's capital market was still developing. It just wasn't mature enough or deep enough to be that powerful engine we think of. Instead, it was acting more like something else entirely.
Okay, case closed. We figured out the direction of the influence. But what's the final verdict here? What does this all mean? Not just for Nigeria back then, but for how we think about the way all kinds of different economies work.
Here's the big takeaway. For an emerging economy, the stock market might not be the engine pushing the car forward. It might be more like the rearview mirror, just giving you a perfect reflection of the road the economy has already traveled. It was a result of real growth, not the cause of it.
So how do you fix that? Well, the study doesn't just point out the problem, it actually offers a prescription. To turn that mirror into an engine, the researchers laid out a 3-step plan. Step 1, actively develop and grow the capital market to make it deeper and more efficient. Step 2, get more people investing, encourage wider participation. And Step 3, promote a private sector-driven economy to create real opportunities for that market to fund. And that leaves us with one final big picture question to chew on. This case from Nigeria shows us that a market's role isn't set in stone. It can change, it can evolve. So the ultimate challenge for any growing economy is this. How do you transform that rearview mirror into a powerful engine that actually builds the future? That's a critical question to think about. Thanks so much for tuning in.